When you're logged in, you will find yourself on the Readiness Level Summary page. Here you have two options to open the Venture Valuation Assessment. You will find Access in the pull-down menu labeled Tools, and the other option is in the permanent display box on the right-hand side of the screen. To use the Venture Valuation tool requires that the Risk Readiness Level Assessment be complete, and also that the information requested is provided. The first information requested is the average price-earnings ratio for the industry sector. This PE can range from 5 to 80 given market conditions and given market sectors. Currently, a PE between 15 and 20 is a reasonable number to use, particularly if you're in doubt as to what is the right number. As PE numbers get higher, the valuations become less reliable. The average PE for an industry sector can be found in financial websites and in business newspapers. Next, enter the amount of investment capital being sought. Use the pull-down menu to select the stage of your investment opportunity. Pre-seed stage represents a concept company. Seed stage represents a company with no product and no revenue. A round or early stage represents a company with product but yet no revenue. B round or mid stage represents a company that has product and revenue. A C round means that the company is making a profit and growing market share. And mezzanine means that the company is moving towards a merger or an acquisition. Next, enter 5 years of net income, that is, earnings before income tax, depreciation, and amortization, beginning with the current year of operation. If numbers are not available, it will not be possible to generate either a discounted cash flow, an earnings multiple, or a venture capital method valuation. Once the information is provided, click Calculate Valuation. For pre-seed, seed, and A rounds, the default method and the Goldsmith method probably are the most appropriate valuation methodologies. The multiple earnings method is most appropriate for service-based companies with a history of revenue, and the discounted cash flow is most appropriate for venture-type companies with revenue. These valuations are based upon national venture capital averages for pre-money, average investment, and post-money valuations. Valuations will vary by industry sector and by geographic locations. Interpretation of valuations should be taken as a general but realistic representation of industry averages. The valuation is ultimately a mutually agreeable value between the company and the investor. Reminder: select the radio button of the valuation method for which you want to generate a cap table. This can be repeated for each of the methods to create multiple cap tables for multiple analysis. Most of the venture capital tool assessments have a feature that provides insight into the importance of the assessment question. To get access to this information, click on the circle with the question mark. Clicking on the question mark will open a dialog box that provides insight into the importance of the question. There are multiple ways to generate funding for a business venture. The most common financing methods fall into two primary categories: debt and equity. Equity is financing provided by a third party in exchange for a percentage of ownership in the company. When seeking equity to finance the business, it is necessary to develop a present value of the company. There are multiple methods to determine the present value. In most cases, the value is based upon the future economic potential of the company when it is a fully operational business. One method to determine the future economic potential is based upon the future earnings potential of the company. A second method is to compare this company with a successful public company at a point in time when it went public. A third method is to compare this company with the acquisition price of similar companies when purchased by another company. A fourth method is to compare the risk profile of this company with other companies when funded at the same stage of development. In every case, it's important to recognize that the investor will apply a discount value to take into account that this company has not yet reached a stable stage of business operations. In discussing valuation, there's some key terms to understand. Investment represents the amount of capital the entrepreneur needs from the investors. The term pre-money represents the computed value of the venture before the new money is invested. Pre-money investment is usually negotiable between the entrepreneur and the investor, and pre-money is one of the hardest things to determine in arriving at the investment model. Once a pre-money is determined with the initial investor, that valuation should apply to all other investors in the same round. The term post-money represents the sum of the pre-money value plus the total amount of the new investment. The term equity ownership represents the percentage of the investor's investment of the post-money valuation. To determine a realistic valuation, it's important to know what is typical within the venture capital industry. This slide shows the national average for pre-money valuations in orange, the national average investment for the stage of development, and the resulting post-money valuation in blue. The actual valuation will vary by industry. In other words, the average value for a biotech deal will differ from a software deal. However, these variations seldom differ significantly from the national average. The purpose of the venture valuation assessment is to provide a realistic valuation range for the company. Remember, the higher the valuation varies from the average for your stage of development, the more difficult it will be to raise money. This slide identifies the importance of valuation. Aside from determining the percentage of ownership and the potential return on investment to the investor, the valuation often determines the tone of the relationship. In other words, if both parties are relatively satisfied with the valuation, the company and the investor are of like mind. However, initial dissatisfaction can lead to an adversarial relationship throughout the period of the investment. It's also important to remember that investors require exponential returns. For instance, a typical investor would expect a 2 or 3 times return on their investment over a 2 or 3 year period of time, or a 5 or 6 times their investment over a 5-year period of time. Less experienced entrepreneurs often think in terms more like interest rates and bank rates than they do in terms of exponential returns. Valuation is not an exact science. Valuations will vary with market conditions. For example, when the stock markets are doing well, valuations are high. When the market's doing poorly, valuations are low. When the markets are performing poorly and IPOs, mergers, acquisitions are slow, it puts downward pressure on all levels of investors. Each level of investor becomes more risk adverse. Another challenge of valuation is determining the right discount value for valuing the company. Every company will be discounted against a current market standard, which is usually a successful company comparison. Some companies will be more mature than a pure startup company, but not quite a product company, making a discount factor more difficult to determine. The phrase term represents the time a company will need the investment funds before it realizes a liquidity event, which is the point in time the company returns the investor's investment plus any gains. If it takes longer to generate the investor return than originally forecast, the investor will realize a lower rate of return than expected. There are multiple ways to value a company. Each has advantages and disadvantages. In addition, as intellectual property becomes more valuable as a competitive advantage, it becomes more difficult to assign appropriate values. This chart above provides the advantages and disadvantages for various valuation methods. In general, valuations using financial data are more appropriate for companies with an actual history of cash flow. Comparables are more appropriate for startup and early stage companies where revenues are less predictable. Each of these methods will be discussed in more detail. Some of the variables applied to valuation are presented in this slide. Typical discount variables include 80% for pre-seed investments, 60% for seed stage investments, and 40% for early stage investments. This is a risk-reward discount that is the equivalent of saying the chances of a pre-seed deal, for instance, of being successful are less than 80%. Every business plan requires a 5-year pro forma reflecting the EBITDA for each year, that is, the earnings before interest, taxes, depreciation, and amortization. The amount of the investment should be an amount that reflects the negative cash flow in the financial pro forma during the investment period. The investment amount should also reflect the intended use of funds during the investment period. The price earnings average for the industry is necessary for calculating the venture capital valuation method. The top portion of the slide reflects where each of these data points are entered. Keep in mind, an unusually high PE number will completely discredit the VC valuation method. This will be reflected when compared to other valuation outcomes. The bottom half of the slide reflects the default methodology, which is basically a reality check for valuation. This method simply identifies the equity interest an average investor would expect in an average investment opportunity for that stage of development. It does not take into account any financial, market, management, or value proposition factors related to the quality of the deal. The discounted cash flow is a widely used valuation method, particularly for companies with a history of revenue. This approach calculates the net present value of the net earnings for each of the years in a 5-year pro forma. The discount value applied depends on the stage of development. These discounts are as follows: 80% discount for pre-seed deals, 60% discount for seed deals, 45% for an A round, 35% for a B round, 25% for a C round, and 15% for a mezzanine round. The post-money valuation is the sum of the net present values for 5 years. The pre-money valuation is the sum of the post-money value less the amount of the investment. The earnings multiple valuation method is best for companies also with a history of earnings. This valuation method first calculates the average earnings for 5 years. To calculate the pre-money valuation, the 5-year average is multiplied by a factor of 0.5 to calculate the pre-seed valuation, 1.0 for the seed stage, 2.0 for an A round, 3.0 for a B round, 4.0 for a C round, and 5.0 for mezzanine. The post-money is determined by adding the amount of the investment to the pre-money valuation. The VC method has a variety of iterations. This particular one requires the 5th year earnings from the financial pro forma in the business plan. The 5th year earnings projection is multiplied times the PE ratio for that particular industry sector. The net present value of that number is calculated, discounting for the stage of development and the time to an exit strategy or liquidity event projected for the company. This will produce the pre-money valuation. A seed stage deal is discounted by 60% with an expectation of 7 years to liquidity. An A round deal is discounted by 45% with an expected liquidity event in 5 years. B rounds 35% in 3 years, C rounds in 25% in 2 years. The post-money valuation is found by adding the amount of the investment to the pre-money value. Equity percentage is calculated by dividing the amount of the investment by the post-money value. The Goldsmith method was developed to calculate valuations for startup and early-stage companies that have no or little reportable revenue. This method is dependent on the results of the risk readiness assessment taken previously. This valuation approach assigns a maximum pre-money valuation for each stage of development based upon national funding averages. The maximum amount assigned to a pre-seed stage deal is $500,000. The maximum amount assigned to a seed stage company opportunity is $3 million. A rounds $16 million, B rounds $40 million, and C rounds $65 million. Each risk factor is weighted according to its importance to the investor. Management risk has the highest weight among the risk factors, followed by market, product, execution, and finance. The sum total of the risk factors equals the pre-money value. The investor percentage of equity is calculated by dividing the investment amount by the post-money value. This chart demonstrates that venture valuations will vary depending on which methodology is used. The same financial variables were used in each of these respective valuations to generate the pre-money and post-money valuations. The purpose of using multiple methods is to get a sense of the range of reasonable valuations. When talking with investors, they are primarily interested in the validity of the pre-market valuation. One approach is to pick the method most appropriate for the company depending on its stage of development and revenue history. In other words, a company with 2 or 3 years of revenue could be comfortable using a discounted cash flow, earnings multiple, or venture capital method. Startup and early stage companies probably more comfortable using the Goldsmith or default method. Another approach is to throw out the highest and lowest valuation, average the remaining 3 to generate a valuation. Keep in mind that the valuation methods dependent on the company's financial projections are only as good as the projections. Some investors will automatically reduce the company's financial projections by 50% to account for what they consider to be the entrepreneur's exuberant enthusiasm. Once you've calculated the valuations, pick the one that represents your favored value by clicking the circle next to the valuation method. Now click the Save button to capture your preference. You're now ready to move to the capitalization table. Click Continue to Capitalization Table. This completes the discussion for using venture valuation assessments.